Welcome to Finance with Fairbanks, where real-world finance comes to life. Remember to like this video and subscribe to the channel. Hello and welcome to another video. My name is Dr. Fairbanks, and in this video we are going to continue to work through a bunch of calculation problems that will help you get prepared for exam number 2. Let's go ahead and begin. Question number 1. Josh expects to receive $1,500 5 years from today. Assuming a discount rate of 7% compounded annually, calculate the present value of this cash flow. If we draw the timeline, what we will realize is that there are no additional cash flows on it, and that there is only a single cash flow expected to be received at the end of year 5. Our objective in this problem is to find the present value today, or PV0, of this single cash flow. To do this, we just simply bring this cash flow back 5 periods by discounting it at a rate of 7%. Let's go ahead and list our time value of money input parameters. So we have our N, IY, PV, PMT. We know that he expects to receive this cash flow exactly 5 years from today. The discount rate that we're going to use to bring this cash flow back to today is 7%. It is compounded annually. We are trying to solve for the present value. There are no period payments being made in this example, and the amount of the future value is $1,500. 5 for N, 7 for IY, 0 for PMT, 1,500 for my future value. Compute present value. What we find is that Josh would be willing to pay $1,069.48 today to receive $1,500 exactly 5 years from today. Okay, next question. Lisa plans to deposit $300 today into an account that promises to pay 5% compounded annually. Calculate the value of this account exactly 10 years from now. In this problem, what we're trying to do is she is going to deposit $300, so we're going to put a negative sign in front of it because our cash flows have to have a story, and the story is she's going to deposit this into an account that's an outflow. And we want to know the value of this account exactly 10 years from today. So we are looking for FV10. Similar to the prior problem, this is a single lump sum cash flow. She's not making any additional deposits to the account. She's just making a single one-time deposit into the account, and we want to know what is it going to be worth 10 years from now. Let's go ahead and list our time value money inputs. We know that our N is 10. Our IY is 5. Our PV is negative $300. She's not making any additional period payments, and we want to know the value of this account in 10 years. 10 for N, 5 for IY, 300 negative for my present value, 0 for my payments. Compute future value. The value of her account in 10 years will be approximately $488.67. All right, we're continuing with the same problem, but we're doing different calculations. So as you can see here, Lisa still plans to make that same deposit, $300 today, into that same account that's promising to pay 5% compounded annually. However, this time we're going to calculate the total interest earned, the total simple interest earned, and then the interest on the interest that was earned exactly 10 years from now. We already know from the prior example that the future value of this account at time 10 is going to be $488.67. Now we need to calculate the total interest earned. To do this, we simply take the future value at time 10 and we subtract off the original deposit. That means that the total interest earned on her account was $188.67. How did we arrive at that value? We took the future value of $488.67 and we subtracted off her original deposit of $300. Next, we'll calculate the total simple interest that was earned on the account. Now, recall the total simple interest earned is equal to the number of years times the annual rate times the original deposit or present value. In this example, we had 10 years, we had a rate of return of 5%, and we had a present value of $300. If we do the math on this, we should find that the total simple interest earned was $150. All right, one last step here. We want to find the interest on interest. And to do that, all we have to do is take the total interest that was earned and subtract off the simple interest that was earned. So we take the $188.67 of total interest, we subtract off the $150 of simple interest, and we find that Lisa earned $38.67 in interest on interest by allowing the interest in the account to also earn interest on itself. All right, continuing with the same math here, it says Lisa plans to deposit $300 today into that same account that pays 5% compounded annually. However, this time we're going to use the rule of 72 to determine how long it is going to take for her account to double in value. That means to go from $300 to $600. Then we'll use the financial calculator and we will find the exact number of years that it will take for her account to double. Recall that the rule of 72 says that the number of years that it will take to double your account is simply equal to 72 divided by the rate that you can earn or expect to earn. In this problem, we expect to earn a 5% rate of return, so we'll take 72 and divide it by 5. And when we do that, we find that it will take 14.4 years for her account to double in value. Now, if we want to find the exact number of years that it will take for her account to double, we will use our time value of money calculator to do so. In this question, we're trying to solve for N. We know that her rate of return is 5%. We know that she's going to deposit $300. She's not going to make any period payments. And we want to know how long it's going to take for her account to double. So the future value in this problem is $600. We plugged in 5 for IY, negative 300 for PV, 0 for the payment, and a positive 600 for the future value. Again, our cash flows have to have a story. The story is that we're making this deposit today. That's an outflow. When it doubles, that will be an inflow, and we will withdraw that amount from the account. Compute N. It will take approximately, well, in this case, exactly 14.207 years. Now, what we can see is that the rule of 72 does a fairly reasonable job of giving an approximation to the number of years. But again, to know the exact number of years or periods, we need to use the financial calculator. All right, Sally owes $35,000 on her student loans, which have a 6% APR compounded monthly. If she pays $850 a month, how many months will it take to pay off her loan? The key here is to realize that we have a monthly payment and we have monthly compounding periods, so we need to make the proper adjustments in our calculation. Now, remember from lecture that I mentioned that if we have multiple compounding periods per year, and in this example, the compounding periods per year happens to equal 12, there are three things that have to match in terms of the periodicity or the compounding periods. And that is N needs to be the number of months, IY needs to be a monthly period rate, and the payment needs to be a monthly payment in order to use this financial calculator. We know that our compounding periods per year is 12. We know that our APR is 6%. So for the IY, I'm going to take 6 and divide it by 12. My present value, or Sally's present value, is the $35,000 that she owes on the account, her student loans. She's going to be making a deposit of $850 into this account at the end of every month, beginning 1 month from today. And her loan here in this specific example is going to be 0. We're trying to determine the number of years, but first we must find the number of months. We'll plug in 6 divided by 12. We do have to hit equals there into our IY. 35,000 for the present value. 850 negative for the payment. 0 for the future value. Compute N. So the total number of months that it will take for her to pay off this loan is approximately 46.22 months. In reality, she'll be making 47 monthly payments, but that last payment, the 47th payment, won't be a full $850. But to find the answer, because this specific question asks for the number of years, we're going to take this number and simply divide it by 12. So the total number of years that it will take for her to pay off this loan is approximately 3.85 years. Kingston wants to retire with $1 million in exactly 35 years. He plans to deposit $4,500 a year at the end of each year. That tells me that this is going to be an ordinary annuity. Remember, the definition of an annuity is a constant set of cash flows for a finite period of time. The period of time is 35 years. The cash flow is $4,500. It's not growing. It's not changing. It's a constant cash flow, and it's made at the end of each period, which makes it an ordinary annuity, not an annuity due. In this specific question, we are asked to calculate the rate of return that he must earn in order for him to be able to reach his goal. So we're solving for IY now. We know that he has 35 years until retirement, and at the end of each year for the next 35 years, he's going to deposit $4,500. We'll put a negative sign in front of that value. He wants to retire with $1 million, exactly 35 years from now. He has nothing saved today, but if he did and he made that deposit today, we would plug that into the present value. And we're trying to solve for the interest rate that he must earn in order to reach his goal. Clear our time value money parameters. 35 for N, 0 for the present value, 4,500 negative for the payment, $1 million for the future value. Compute IY. We find that Kingston must earn 9.13% per year on average in order to reach his goal in the next 35 years. Bank A offers a 5-year loan with a 7% APR compounded weekly. So we'll use 52 compounding periods per year in this example. Calculate the weekly period rate and the effective annual rate on this loan. So first we'll find the weekly period rate. And recall, to do this, all we have to do is take the APR and simply divide it by the compounding periods per year. So we take the 7%, divide it by 52, and we find that the weekly period rate is 0.1346% per week. All right, next we are going to use our interest rate conversion worksheet. That's ICONV in our financial calculator. And remember, there's 3 inputs in this worksheet. There's the nominal rate, which is the APR. We know that that's 7%. There's EFF, which is the effective annual rate. That's what we're trying to solve for. And then it asks us to plug in the compounding periods per year, which happens to be 52. To access this worksheet in our financial calculator, we hit the second key and the number 2. That brings us into the interest rate conversion. As you can see, hovering above the number 2 key is ICONV. You can see here is my nominal rate. I'm going to plug in 7 and hit enter. We're going to arrow down 2 times and type 52 and enter. We're going to arrow up and hit compute. The effective annual rate on this loan that Bank A is offering is 7.246%. Okay, Bank B offers a 10-year loan with a 6% effective annual rate. It has daily compounding, so in this example, we will use 365 compounding periods per year. We're going to calculate the APR, and then we're going to calculate the daily period rate on this loan. Once again, we will use our interest rate conversion worksheet within our financial calculator. The effective annual rate on this loan is 6%. Remember, that's what you actually earn or pay if it was a loan. But what Bank B actually has to quote is the APR, so we'll use the calculator to find the value of that through the NOM, or the nominal rate. The compounding periods per year, once again, is 365. Let's go ahead and get into this worksheet. We'll hit the second key and ICONV, or the number 2, to access this. We'll arrow down to the EFF. We'll type 6 and enter. We'll arrow down again to the CY, or the compounding periods per year, and type 365 and enter. We'll arrow down again to get to the nominal value and hit compute. So the actual rate that the bank would have to quote would be 5.827%. This is the APR on the loan. But we are also asked to find the daily period rate. To do that, we are going to take the APR and we're going to divide it by 365, because that's the number of compounding periods per year. If we do that in the financial calculator, we'll simply take the nominal value that we solved for and divide by 365. And we find that the daily rate is 0.01597%. This is the daily rate. Okay, this is probably one of the most important problems that we work in time value of money. This is a life skill, in my opinion, because being able to calculate your own amortized payment is very, very important. You can do this for student loans, you can do this for car loans, you can do this for mortgages. In this particular example, Josh needs to purchase a new Suburban. It costs $85,000. GM Financial is offering him a 60-month loan with an APR of 4.9%. It is compounded monthly, and he also plans to put $30,000 down on this purchase. We are asked to find the monthly payment, the total dollars paid to the bank, the total interest paid on this loan. Then we are going to jump in to the amortization worksheet within the financial calculator. We're going to find the balance of the loan after the 12th monthly payment. We're going to calculate the interest portion of the 12th monthly payment, and we're going to find the principal portion of the 12th monthly payment. Now, step one in this problem is to find the amount that he must borrow from the bank. Now, the loan amount is equal to the price of the vehicle, the out the door number, minus his down payment. And what we find is that we're going to borrow $55,000 from the bank to finance the purchase of this new vehicle. Now that we know the loan amount, we can set up our TVM inputs, and we're going to solve for his monthly payment. We know that the number of months that he's going to be making payments is 60. It's a 5-year loan, so 5 times 12 is 60 monthly payments. His IY is the APR of 4.9% divided by 12, because we've got to convert that to a monthly rate. Then we have the present value, which is the loan amount. That's the $55,000. That was step one in this problem. We are solving for his payment, and once again, the future value of this loan is 0. Okay, let's plug in 60 for N. We'll type 4.9 and divide it by 12 and hit equals to find the monthly period rate. We have $55,000 for the present value. That's the amount that he borrowed. And we have a zero value for the future value. Go ahead and compute the payment. We find that his monthly payment is $1,035.40. Okay, next we're going to calculate the total dollars paid to the bank. How do we do that? We take his monthly payment and we simply multiply it by 60. Okay, so again, we just take his monthly payment that we just calculated and we multiply that by 60, and we see that the total dollars paid to the bank, that's interest and principal, is $62,124. In the next part of this question, we're asked to find the total interest paid. Well, we know the total dollars paid to the bank, so all we have to do now is subtract the principal from this amount. That means that we take the $62,124 in total dollars paid to the bank. We subtract off the amount that he borrowed, the $55,000, and what's left over represents the total interest paid on this loan. And we see that the total interest paid on this loan was $7,124. Now, we can get to this exact same answer through the amortization worksheet within the financial calculator. And to do that, again, we will enter the amortization worksheet through the PV button by hitting second PV. So let's do that. And we have two key inputs here. We have P1 and we have P2. If I want to know the total interest paid over the entire loan without doing these extra calculations, I would simply change P2 to 60 because that's the entire term of this loan. It's 60 months. Now when I arrow down, I see that the balance at the end of the 60th payment is 0. I see that the total principal paid on this loan, the amount that was borrowed, was $55,000. And I also see that the total interest paid on this loan was $7,124. That's the advantage of using the amortization worksheet within the financial calculator. Now, to answer the next three questions, we want to find the balance of the loan after the 12th monthly payment is made. We want to see the interest portion of the 12th monthly payment, and we also want to see the principal portion of the 12th monthly payment. Now, unlike an Excel spreadsheet where we can see every single row of the amortization worksheet, we can't see every single row simultaneously within our financial calculator. However, through that amortization worksheet within the calculator, we can access all of the information from a single row in that table one at a time. And in this example, what we're going to do is we're going to go back to our P1. We're going to change it to 12 and hit enter. We're going to change our P2 to 12 and hit enter. When you set P1 and P2 to the exact same value, you are looking at a single row within the amortization table. We're trying to access the 12th payment in this table, and to do so, we just set P1 and P2 to a value of 12. Now, when I arrow down, I find that the balance on his account after he's made 12 payments to this loan is still $45,048.68. If I arrow down again, I can see, remember that his payment was $1,035.40, but the principal portion of that 12th payment was $847.99. Additionally, the interest portion of that 12th payment was $187.41. We were able to answer the final three questions simply by using the amortization worksheet. And we don't have to actually build the table here to answer this question. We just use this worksheet to do so. So all I did here was write the answers to those three questions on the slide, but we've already seen that in the financial calculator. Let's move on. In this example, Cashton plans to deposit $400 a month at the end of each month for the next 40 years. He expects to earn a 6% rate of return on his account, and this account is going to compound monthly. He has no nest egg, he has nothing saved today, and we want to calculate the value of his retirement account exactly 40 years from today. Once again, this is an ordinary annuity. It's a constant set of cash flows for a finite period of time. We'll go ahead and set up our time value of money parameters. Now, because this is monthly, we have 40 years times 12. That equates to 480 monthly payments that Cashton plans to make into this account. We also have to convert that APR into a monthly period rate. So that's 0.5% per month. He has nothing saved today, so the present value is 0. His period payment or his monthly payment is going to be $400. It's an outflow, so we'll make that negative. And we're trying to find the value of his account exactly 40 years from today. Let's clear our inputs. 480 for N, 0.5 for IY, 400 negative for payment, 0 for present value. Let's go ahead and compute the future value. So the future value of his retirement account 40 years from today will be $796,596.29. Okay, so we know the balance of his account 40 years from now. Now in this next part of the question, it says, given his retirement account balance, he would like to make annual withdrawals, with the first withdrawal being made the day he retires. He also plans to spend it all over the 15 years in retirement. He expects to earn only 4% compounded annually while in retirement, and we want to calculate how much can he withdraw from this account. Now, in the first part of this problem, this was an ordinary annuity. And in the second part of this problem, it's an annuity due. But as I mentioned in prior videos, it's best just to keep your calculator in end mode. Treat it like an ordinary annuity. And then what we will do is we will adjust the answer once we have solved for his annual withdrawal. Let's go ahead and set this up. Okay, once again, we are setting this up like it's an ordinary annuity, but we will adjust our answer once we find it. He's going to be in retirement for 15 years. He's also going to be making 15 withdrawals from this account. He's going to earn a 4% APR compounded annually. He is not going to have anything when he passes away, so he's going to spend it all while he's in retirement. And this future value that we calculated earlier, the balance of his retirement account, now becomes the present value of his account. And we are tasked with finding the annual payment. Okay, so let's go into our financial calculator. And we already have the answer here. So what I'm going to do is just hit PV to store that number into the PV button. That gives me all the decimals. I'm going to type 15 and N 4 and IY, 0 for the future value, and I'm going to compute the annualized payment. Now, again, we treated this like an ordinary annuity. We did not change our calculator from end to beginning mode because we don't want our calculator to be stuck in that framework. And what we found is the annual payment, assuming he makes these withdrawals at the end of every year for the next 15 years. But we're going to adjust it, so let's go ahead and write this answer down. $71,646.75. To convert this answer, this annual payment, into an annuity due, what we're going to do is divide it by 1 plus the period rate. So we're going to divide by 1.04 to convert it to an annuity due payment. So I take this answer that we just found, I'm going to divide it by 1.04, that's 1 plus the period rate. It is annually compounded here. And we find that his annuity due payments, his first withdrawal from that account, is going to be $68,891.10. That is the correct answer. Okay, moving on. Microsoft has preferred stock outstanding that pays an annual dividend of $4.32 per share forever. Once I see that word, I automatically know that this is going to be a perpetuity. If investors require an 8% rate of return on their investment, how much are they willing to pay per share? To answer this problem, we simply need the perpetuity formula, which we know is the present value is equal to the cash flow. And notice that there's no subscript on the cash flow because it's assumed that the cash flow at 1 is equal to the cash flow at 2, which is equal to the cash flow at time n. And we simply divide that by the rate. The cash flow here is the annual dividend of 4.32 or $4.32. We then simply divide that by the 8% and we arrive at the answer. An investor would be willing to pay $54 per share to acquire this preferred stock. All right, NVIDIA will pay a 25-cent annual dividend next year. Investors expect this dividend to grow at 5% per year forever, and they require a 6% rate of return on their investment. Calculate the present value of this dividend. Once again, the term forever tells me that it's a perpetuity, but in this problem, these cash flows are expected to grow. So we have a growth rate of 5%. We have a required rate of return of 6%, and we know the cash flow exactly 1 period from now is 25 cents. Given this information, we can use the growing perpetuity formula, which says that the present value today is equal to the cash flow next year or next period, simply divided by R minus G. Again, with the constraint that R must be greater than G. So the numerator is 25 cents. The denominator is 6% minus the 5%. And what we find is that an investor would be willing to pay $25 per share to acquire this investment. Let's check it with the calculator. We'll take 0.25, we'll divide that by parentheses 0.06 minus 0.05, that's the 6% required rate of return minus the 5% growth rate. And we see, just like we said, that an investor would be willing to pay $25 to acquire this share of NVIDIA. Fair & Co. offers their employees an annuitized bonus. The bonus pays their employees $1,000 at the end of each year for 10 years. Assuming a 7% rate of return, calculate the present value of this bonus. Once again, this is an annuity. It's an ordinary annuity because the cash flows are being made at the end of every period. We could draw the timeline for this example. And what we would see is that at the end of every year, this individual would be receiving $1,000. Our objective here is to find the value of this bonus today. Let's go ahead and set up our TBM inputs. The bonus is going to make payments at the end of every year for the next 10 years. So N is 10. The rate of return on this investment is 7%. We are trying to solve for the present value. The payment that they are going to receive through this bonus is $1,000, and then once all payments are made, the value of this bonus will be 0. Let's clear our inputs. 10 for N, 7 for IY, 1,000 for the payment, 0 for the future value, compute present value, and what we find is that this overall bonus today is worth $7,023.58. Lisa plans to deposit $50 weekly for the next 10 years, starting today. That tells me that it's an annuity due. She expects to earn 6.5% APR compounded weekly on this account. Calculate the future value of this account 10 years from today. Once again, when we set this problem up, we're going to treat it like it's an ordinary annuity, and then we will simply make the adjustment once we have found the future value. Let's go ahead and set up our inputs. All right, N is 10 years times 52 because the compounding periods per year happens to be 52. It's weekly compounding. That means that there's going to be 520 weekly deposits into this account. She's going to earn 6.5%, but we have to divide that number by 52. She's not making any deposits today in this problem, the way we're setting it up. And her weekly payment is going to be $50. And the future value is what we are trying to solve for. Let's clear our inputs. We have 520 for N. We take 6.5, the APR, and divide it by 52 to convert it to a weekly rate. We take 50 for our payment, 0 for our present value, and we find the future value of this account. And what we find is that the future value of this account is $36,590.54. But we're not done, because the way we've set this problem up is we've assumed that this is an ordinary annuity, and it's not, because the first payment is going to be made today. So to make this adjustment, all we need to do is multiply by 1 plus the period rate. Well, the period rate is the weekly rate, and that's the 6.5% divided by 52. So we need to take this $36,590 and we need to multiply it by 1 plus that's 6.5% divided by 52 to convert this answer into an annuity due value. So once again, here is our answer that we solved for in the financial calculator. We're going to hit multiply, open parentheses, 1 plus, open parentheses, 6.5%, divide that by 52, and hit equals. And what we find is that the future value, if this is an annuity due, of course it has to be greater, we know that from our lecture, is $36,636.28. King Cash Co. expects to receive $40,000, $50,000, $50,000, $60,000, and $70,000 at the end of each of the next 5 years. Assuming they require a 10% rate of return, calculate the present value of this stream of cash flows. First, we want to visualize the cash flows, so we'll go ahead and draw a timeline. And the company is going to receive $40,000 at the end of year 1, $50,000 at the end of year 2, $50,000 at the end of year 3, $60,000 at the end of year 4, and $70,000 at the end of year 5. Our objective is to find the present value today of this uneven or non-constant stream of cash flows. To do this, there are a variety of different techniques that we can use. As we've learned in prior videos, there's 3 different approaches. However, in this video, what we're going to do is simply use the cash flow worksheet within our financial calculator. Let's set it up. Okay, our cash flow worksheet, our times 0 cash flow, or CF0, will be 0. Our C01 is 40,000. Our C02 is 50,000. Our C03 is also 50,000. And we'll just leave the frequency on all of these as 1. That just makes things easier. C04 is 60,000. C05 is 70,000. Then we will go into our NPV worksheet. And we will set the discount rate on this set of cash flows to 10%. And we are trying to find the present value. All right, to enter the cash flow worksheet, we simply hit the CF button right next to the second key. You can see here is CF0, the initial cash flow. But before we do that, we want to make sure we clear it out. So let's clear it all out. We'll arrow down to C01. We'll type 40,000 and enter. Remember, we have to hit enter to store it into the worksheet. We arrow down 2 times to get to C02. We'll type 50,000 and enter. We'll arrow down to C03. 50,000 and enter. I'm skipping over the F0s because those are the frequencies and we don't need those here. We have 60,000 for C04 and 70,000 for C05. This cash flow worksheet is a beautiful tool within our financial calculator because once we've drawn the timeline, we can recreate that exact same timeline within this worksheet. We'll now go to the NPV. We'll type 10 and enter. We'll arrow down and hit compute. The present value of this non-constant stream of cash flows today is $199,696.99. Once again, King Cash Co. expects to receive that same set of cash flows over the next 5 years. We have the same required rate of return of 10%. However, this time we want to find the future value of this stream of cash flows. Now, since we've already found the present value of this stream of cash flows, which makes things really easy because we did this in the prior problem, and we know that the present value is $199,696.99. Once we've brought everything to the same point on the timeline, we can now treat this stream of cash flows like a lump sum cash flow, and all we have to do is simply send this single cash flow to the end of year 5. N is 5, IY is 10. Present value is what we've just found. We'll put a negative sign in front of it so that we get a positive value on our future value. Payments are 0, and we are trying to find the future value. So I'm going to hit the clear button. That's going to keep the value in the calculator, but this time I'm going to put a negative sign in front of it. I'm going to set it into my PV button by hitting PV. I'm going to hit 5 in N, 10 in IY, 0 for my payment, and compute future value. The future value of this non-constant stream of cash flows is $321,614. All right, we now are moving into our bond calculations. Fair & Co. has a bond with the following characteristics: par value of 1,000, time to maturity of 10 years, a coupon rate of 8%, paying semi-annually, or paid semi-annually. The yield to maturity is 5%. Calculate the present value or the price of the bond. Okay, because this is semi-annually compounded, we have 10 years to maturity. We're going to multiply the 10 by 2 to find 20 semi-annual periods. Our discount rate is the yield to maturity. It is 5%. We will divide that by 2 to turn it into a semi-annual interest rate of 2.5%. We are trying to solve for the bond's price. For the period payment, we take the coupon rate of 8%. We divide that by 2, and then we multiply it by the par value of 1,000. And we find that the period payment, or the semi-annual coupon payment here, is $40. And the future value is 1,000. That is the face value or par value of the bond. And again, we're trying to find the bond's price. Let's clear our work and our time value of money. So we'll enter 20 for N, 2.5 for my IY, 40 for my payment, and $1,000 for my future value. Now it's very important that the sign on the payment and the future value is identical. The story here is we're buying this bond. That would be an outflow. So when I solve for the present value, I will find a negative number. And we have to ask ourselves, does this make sense? This bond is trading at a premium to its par value. Its price is greater than the $1,000 par value. Does that make sense? And the answer is yes, because the coupon rate on this bond is much higher than the actual market rate or yield to maturity of 5%. We find that the bond's price is $1,233.83. Fair & Co. has a bond with the following characteristics: a par value of $1,000, time to maturity of 20 years, a coupon rate of 7%, paid semi-annually, and a price of 82% of par value. We know that this bond is trading at a discount to its par value. We are tasked with finding the current yield and the yield to maturity. Now we know from lecture that if the bond is trading at a discount, that the following relation must hold. The coupon rate must be less than the current yield, which must be less than the yield to maturity. We know that the coupon rate is 7%, so that gives us a benchmark. The current yield must be greater than that, and then the yield to maturity must be greater than whatever we find for the current yield. Let's go ahead and solve for the current yield first. Remember that the equation for the current yield is the annual dollar coupon divided by the bond's price. The price of the bond here is stated as a percentage of par value. We know that the par value is 1,000, so we'll go ahead and calculate the price over here. We know it's 82% of the $1,000, so that's $820 is the current price of this bond. We'll go ahead and find the annual dollar coupon. The annual dollar coupon is the 7% coupon rate times $1,000 par value, or $70. So the current yield here should be 70 divided by 820. And we find that the current yield on this bond is 8.54%. Okay, so that works so far. We know that the current yield is greater than the coupon rate, so that makes sense. Let's find the yield to maturity on this security. All right, we have 20 years to maturity, but it is semi-annually compounded, so we'll multiply that by 2. We find that there are 40 semi-annual periods. We know that the price of the bond is $820. I'm putting a negative sign on that because our cash flows have to have a story. Our payment, our annual dollar payment was 70, but we'll go ahead and divide that by 2 to turn it into a semi-annual coupon payment of $35. And the face value or the par value of the bond is 1,000. Notice that the payment and the future value have the same sign, and that the present value has a negative sign because our cash flows have to have a story. We'll go ahead and solve for the IY here. 40 for N, 820 negative for the present value, 35 for the payment, and 1,000 for the future value. Compute IY. When we solve for the IY in this setting, however, this is a semi-annual interest rate. So what we need to do is we need to multiply it by 2 to find the yield to maturity. And in this problem, we find that the yield to maturity is 8.949%. And it is greater than the current yield. So if you forgot to multiply by 2, if you looked at this relationship at the top here, coupon rate must be less than the current yield, which must be less than the yield to maturity, we would know that something was off because that yield to maturity has to be greater than the current yield. All right, let's look at a problem here where we're looking at a bond price quote. If you ever get confused with the quotes on bonds or stocks or anything of that matter, just remember a used car dealership, right? So we have a bid price and we have an ask price, and a used car dealer, when you try to sell them your car, is going to give you a bid for that car. They're going to give you the bid, you trade it in, you get that bid price. That's why we say you sell at the bid, okay? And then somebody's going to turn around and they're going to buy that used car, and they're going to pay a little bit more for it, and that's what the dealer is asking for that car. That's why we say we buy at the ask price. Okay, and how does a dealer make money? Well, they sell it for more than they gave you, and that difference between the bid and the ask price is a measure of liquidity. The tighter that spread, the more liquid the asset. Okay, so again, we sell at the bid price, we buy at the ask price. In this problem, we're asked to calculate an investor's price to buy $20,000 of par value in this bond. So we're going to take $20,000 and we're going to multiply it by the asking price of $97.85. That is a percent. And what we find is that they would have to pay $19,570 to acquire $20,000 worth of par value in this bond. Next, the problem says calculate the amount an investor would receive for selling $6,000 worth of par value in this bond. Remember, we sell to the dealer at the bid price. So we're going to take that $6,000. We're going to multiply it by the 97.381%. And we find that they would receive $5,842.86. If they were selling the $6,000 worth of par value. Okay, this is the last question in this video, and now we are trying to compare a taxable yield to a non-taxable yield. In this example, it says, suppose a 10-year Treasury note yields 3.89% and a 10-year Knox County note yields 3.65%. An investor has a marginal tax rate of 20%. Calculate the after-tax yield for the Treasury note. Calculate the tax equivalent yield for the Knox County note. And the tax rate that would make the investor indifferent between the two bonds. Now, what we have to know is that the Treasury note is taxable at the federal level, whereas the Knox County note is not taxable, so it's considered tax exempt. And we know that our marginal tax rate is 20%. So let's first find the after-tax yield on the Treasury note. And to do this, we'll take the 3.89% and we will multiply it by 1 minus the tax rate. So we take the 3.89% and we multiply it by 1 minus 0.2, and we find that the after-tax yield on the Treasury note is 3.112%. Now that we have found the value or the yield on an after-tax basis, we can compare it directly to the Knox County note because it is tax exempt. And the conclusion here is that if an investor had a marginal tax rate of 20% and was considering these two investments, then they would prefer the municipal bond. They would prefer the muni, the Knox County note, the tax exempt bond, assuming similar risk and similar times to maturity. We can also find the tax equivalent yield. And what this does is it converts the Knox County yield of 3.65%, and we divide it by the 1 minus the marginal tax rate. And this says, okay, well, what would a taxable bond need to yield to make me indifferent between the Knox County note and a taxable bond? We take this 3.65 and we divide it by 0.8. That's 1 minus the 0.2 marginal tax rate, or the 20% marginal tax rate. And bonds, taxable bonds, would need to be yielding about 4.56% in order for us to be indifferent between this Knox County bond and a taxable bond. And again, now we can compare this to the 3.89. The conclusion is the same. You would prefer the muni here over the Treasury bond in this example. All right, the last part of this question is to find the tax rate where we would be indifferent between these two bonds. And to solve that, what we need is an equation. And the tax rate that would make us indifference, I call it T star, equals 1 minus the tax exempt yield divided by the taxable yield. That's 1 minus the 3.65% divided by the 3.89%. So I take 1 minus open parentheses 3.65% divided by 3.89%, and we find that the tax rate of indifference would need to be 6.17. Now, what does that tell me? It tells me that if I'm an investor and my marginal tax rate is above 6.17%, then I would want to purchase the Knox County bond in this example. All right, folks, that's it for this video. Good luck on the exam. Remember to smash that like button and subscribe to the channel. Until next time, goodbye.